Hello everybody, welcome to the March 31st through April 1st, Monday and Tuesday price action review. So getting started, we are looking at the S&P on the left, the Nasdaq in the middle, and the Dow on the right. So as you all know, on Sunday I said that we wanted to see price retrace back within the range we had created to form a cracking correlation, so then price could continue within the higher time frame direction, which so far we have gotten that retracement. I made a little post on WAP seeing if we could get that reversal to form today, which it didn't. So tomorrow would be the day to look for that intra-week reversal, which we will cover a little bit later on in this video. But we are going to go ahead and look at this portion of price action right here, which would be Monday's price action through the lens of the 1 hour time frame. So now going to the 1 hour time frame, we have our true day open right here. So coming into Monday, since we wanted to see price trade higher and we were looking for higher prices earlier on in the week, you should have been looking for bullish signatures in price. And the very thing that made the low of the day was this hourly TPD. Now, why am I choosing this hourly TPD in specific? Because if you follow the order of operations, there was no 4-hour TPD there. So now the next TPDs that we're looking for are on the 1 hour time frame, and it was with the 9 a.m. candle. So if we look on the Dow, we can see that 10 a.m. opened higher than the 8 a.m. close. So this would be candle 3. This would be candle 1. There's that cracking correlation there between the assets. So on the Nasdaq, candle 3 opened lower than candle 1's close, while on the S&P, candle 3's opened lower than candle 1's close. Now there was no cracking correlation down here solidifying this TPD, which is expected on low probability days, and we already knew that Monday was likely to be a little bit lackluster or difficult to navigate. So on days that are low probability, precision can be skewed, and the textbook examples are permitted to being thrown off a little bit on certain days that you know are going to be low probability. But if you would have taken this TPD, how would you have known which asset was the better one to trade? Because we don't trade the Dow, but if we look between the S&P and the Nasdaq, candle 3 opened lower on both of the assets. So how could you have known which one was better to trade to the upside, which is what we wanted to see? Well, if we take a look at candle 3, we can see the distance between the opening price of this candle compared to the close of this candle is smaller compared to if we were to look at the Nasdaq, the open of this candle, which would be candle 3, to the close of this candle, that range is greater. So the Nasdaq is going to be more likely to kind of lag behind, while the S&P is going to have more of a willingness to run up faster. But going from the 1 hour time frame to the 15-minute time frame, this would be candle 2 through the lens of the 15-minute time frame on all of the assets. So as you can see, since the S&P and the Nasdaq were weaker compared to the Dow, neither the Nasdaq or the S&P had that change in the state of delivery within candle 2. So the reversion level was off a little bit. But as we can see on the Dow created that change in the state of delivery on this candle right here. So this candle's close is higher than this candle's open, this being the lowest down close candle of candle 2, which still validates the Nasdaq and the S&P. And these are the kind of things right here that I leave out of the core content videos. This is why it is important that you follow through and attend each pre-recorded lecture and each live stream, because there are a lot of gems that flow well together with the concepts that get dropped as we continue on. But in summary, as long as one asset creates the change in the state of delivery, then the TPD is still likely to be valid in the direction you're anticipating it to propel price towards. So with that knowledge, we can see that this would be the reversion level right here. So the Dow opens up, trades into the wick, and then propels higher, being the strongest, while the Nasdaq lags behind a little bit, but as soon as it trades above and closes above this candle's opening price right here, we can see that next candle trades still respects this wick and then propels higher. And on the S&P, we can see as soon as this candle right here closes above the opening of this candle, which is still the lowest down close candle, it still drops, treats this as the reversion level, and uses that for higher prices. So in certain predicaments like this, the change in the state of delivery is permitted to form within candle 3 on the weaker assets. And I've said this before in the past, and those that have been with me for a while know, but this is whenever you are looking for that to form. Whenever the Dow is the one that is, quote unquote, the only one tipping its hand, while the NASDAQ and the S&P are moving closer together. So if you would have came into Monday, this would have been the opportunity. So this reversion level would have been the entry, and then you would have targeted higher, following in tune with that higher time frame retracement. But now zooming out, we can see, let's say that you actually did take this down here, but where are you trying to target? Well, we have these equal highs right here on the NASDAQ and these relative equal highs right here on the S&P. Now, what is special about these highs in particular? These highs are the original consolidation. And then this would be the first phase accumulation, and this would be the smart money reversal, and then you're encapsulating the reversion level, targeting the original consolidation highs. And take into note how these highs are unsymmetrical. So if we look on the NASDAQ, we can see that this high is higher than this high, while on the S&P, this high is lower than this high. Typically, the original consolidations, ones that are high probability, will have unsymmetrical price action. So that's a little nugget you can look into. So these highs right here being the original consolidation, that could have either been your full target, or you could have taken a partial right there and then just let the trade ride out. That was how you should have came about operating in Monday. And now going back to the 1 hour time frame, the $1 million question: why did this weekly cycle sequential SMT fail? Because I saw a lot of you were wondering why it failed. It looked picture perfect, but yes, price still disrespected it, and so far we are still trading higher. So the main catalyst as to why this failed is because there was no real second stage confirmation. TPDs and SMTs alone are about 50-50. So this was not a quote-unquote true reversal like I teach, because there was nothing here on the lower time frame confirming this, which is why price ran lower and then just completely blew through it again. It's also important to keep in mind what week of the month we are trading in. As I've stated already, non-farm payroll week is one of the more difficult weeks to trade in the month, so it's not uncommon for things to look picture perfect to fail. And even today, there was no real algorithmic signatures in price that I deem worthy of even reviewing, but that was the main catalyst on why this failed, is because there was no second stage confirmation making this a true reversal, as well as there were no TPDs in there. It was just the SMT by itself. And now going to the daily time frame with what I think is likely to happen next. So we're currently trading inside of this daily fair value gap on the S&P and the NASDAQ. And while I still do keep the same opinion and price, I still would like to see price draw lower and form the high of the week today, being Wednesday, following in tune with weekly halving theory, alongside this weekly SMT on the Dow, because now we have printed 2 of them. So I still upkeep the same bias, which would be these lows for downside expansion. But the invalidation level is, if we were to push higher and price just keeps trading higher and higher and higher, this is my personal invalidation level right now. So if price breaks above this high right here on both the S&P and the NASDAQ, then we could see this staying in tune with low of the week, and then we could see Thursday or Friday printing the high of the week. So in summary, I'm still upkeeping the same bias. It's just if we don't get that cracking correlation to break us lower and price just continues higher and higher and pushes above this high, then I won't be expecting these lows to be delivered anymore. So hopefully y'all found this one insightful. I will speak with you all again tomorrow. Good luck and good trading.